I'm going to go over 6 money and stock market facts that are going to make you more financially savvy and lay the groundwork for you to become a better investor. These 6 facts will help you understand the rules of money. Most formal education doesn't do a great job of teaching us how money works. If you want to do well in any game, you got to understand the rules of the game. Fact number 1, compound interest is the concept where your money's interest generates more interest.
Einstein described compound interest as the eighth wonder of the world. This graph shows a little bit about what compound interest can do. If you started with $10,000 and compounded that at 10% for 20 years, you would have $67,275 in 20 years. This is because each year, the interest generated from the previous years generates interest. The key to compound interest is time and the rate of compounding. In this graph, you can see what 15% rate of compounding would do. So starting out with the same $10,000, after 20 years, you would have $163,000. The key to making compound interest work for you is to find assets that produce a return. One possibility is stocks. Stocks are small pieces of ownership in companies. They are one form of asset that can help you earn compound interest.
Fact number 2, the stock market is not a zero-sum game.
More wealth is being continually created in the stock market. There are many examples of zero-sum games like gambling. In gambling, one person's winnings are another person's losses. Some professions could even be a zero-sum game where the only way you can get a better job is to take someone else's job.
The total market capitalization of all publicly traded securities rose from $2.5 trillion in 1980 to $93.7 trillion in 2020. As you can see, worldwide stock market wealth continues to grow and is not a zero-sum game. You can be part of this growth if you think about money strategically. Over a long history, the S&P 500 has returned on average 10% per year. Fact number 3, movements in the stock market reflect movements in the underlying earnings of the companies in it.
In fact, increases in the S&P 500 over the last 100 years are highly correlated with increased earnings per share. For example, if we look at the company Apple, you can see that its stock price is quite correlated with earnings per share. Earnings per share is shown in green, and the dotted blue line is the stock price. Earnings for the entire S&P 500 have gone up continually over the years, although not in a straight line. The art of stock market investing is the art of picking companies that will have increased future earnings or will be fairly valued in the future. Fact number 4. Value investing is how greats like Warren Buffett and Peter Lynch have made billions. Great investors of the past have had a little better track record picking value stocks over growth stocks.
It is difficult to predict the rate a company will continue to grow, and all fast-growing companies eventually slow down their growth as they become larger. On the other hand, value investing seeks to buy companies that are valued cheaply today, often due to overreactions to bad news. Value investing takes patience. Value investors will typically hold their stocks for years and are not looking to make a quick buck. Again, most of the most successful investors in history are value investors. They combine their ability to identify cheaply valued companies with the principle of compound interest. Over time, this can build vast quantities of wealth. Again, it is important to understand that value investing is not a zero-sum game. The stock market continues to build wealth over time, and right now the stock market is valued higher than it has ever been in the history of the world. Therefore, odds favor the investor. Fact number 5. Inflation is very high right now, and it is continually wiping out your purchasing power.
You should be really worried about this. Do you know that your money is losing value in the bank? The Consumer Price Index has inflation currently at 7.9%. This means your purchasing power is disappearing quickly. Let's take a look at what's happening to your money. That means if inflation is at a 7.9% inflation rate, that means that $10,000 ends up having the purchasing power of $4,391 after 10 years. You lost a lot of money. This probably worries you a lot, and rightfully so. Historically, inflation is a little bit more close to 2%. Let's look at what 2% inflation does to your money. So at 2% inflation rate, that means that $10,000 ends up having the purchasing power of $8,170 in 10 years. This means cash is losing value. High current inflation is tied to the Fed printing money at an accelerated rate. When the government wants to pay for something, they can simply print money to pay for it. This is the root cause of inflation. Imagine if you or I wanted to buy a car and printed money to pay for it. That would be called counterfeiting.
Current high inflation is a worldwide problem right now, which has not always been the case in the past. Fact number 6. In addition to inflation being really high right now, bond interest rates are really low right now.
In fact, since the great financial crisis of 2008, real interest rates have actually been negative. Real interest rates are defined as the nominal interest rate of the 1-year treasury minus the rate of inflation. And you can see here that the blue line is below zero, meaning negative. After the 2020 stock market crash due to COVID-19, you can see that the 1-year treasury yield was very close to zero until recently. These times since 2008 are unique in that you do not earn real interest by having your money in the bank. The Fed funds effective rate has been very close to zero ever since the great financial crisis. Currently, it sits at a 0.2%, which is probably close to the money that you might be making in a money market account if you have a money market account.
Additionally, investing in bonds right now is not that attractive an alternative, as bonds have lower interest rates than inflation right now. Historically, portfolios are comprised of 60% stocks and 40% bonds.
In these times, 40% holding in bonds do not make quite as much sense as they did in the past.
You guys have worked hard for your savings and you don't want to see your
Purchasing power eroded by inflation.
So what can you do to preserve your purchasing power? Many experts say investing in value stocks from mature companies that pay a dividend could be an answer.
Gold and other commodities have often done quite well in times of inflation for preserving your purchasing power, but may not provide a real return. Real estate historically has done okay in times of inflation. However, currently real estate is very expensive.
Mortgage rates are on the rise, which may have the effect of pushing home prices down to a point in the future where they may be attractive for purchase.
In conclusion, money is not safe in the bank, as your purchasing power is being eroded quickly. Gaining financial awareness can protect us and our hard-earned purchasing power from being taken away from us.
If you like this content, please consider subscribing to see more information related to finances in the future. If you have other ideas or points to make, please leave them in the comments below.